Okay. So we are starting our discussion with the taxation of C corporation. So basically, a C corporation file its form 1120 and pay the taxes at entity level as well as the individual level also when the distribution are happens to the shareholders. They have some other schedules also, like Schedule B, Schedule C for dividend, Schedule J for tax computation. They have also Schedule L, M1, M2, and M3. Okay. So for a C corporation, basically they will show their income, their expenses. They have ordinary deductions. They have charitable contributions. Some special kind of deduction is also given to C corporation like DRD. They have also annual deductions. So after subtracting this deduction, the tax is calculated for C corporation. For C corporation, the tax rate is 21%. Okay. So starting our discussion with the first topic, that is the difference between book and tax income. So basic requirement for a C corporation. Sorry. Okay. So basic requirement for a C corporation to file the form schedule M1, M2 and M3. So basically in schedule M1 they show the reconciliation from tax income to the book income. So what is the difference between book income versus taxable income? So basically there are certain items which are either recognized in book or in tax purposes which give rise to some of the difference which is called as permanent or temporary differences. So these differences are reported in this schedule. Book income versus taxable income. So purposes of book versus tax reporting. If we talk about our book income, it basically shows about the economic performance. It uses matching and accrual concept and it is used for investors, creditors, lenders, regulators. Whereas if we talk about our taxable income, it basically measures the income which is subjected to tax. That means you do not have to include the item which are tax exempt or not deducted for the tax purposes. Next is based on statutory rules and it is basically prepared for the IRS. So that means due to some of the differences, our book income is not equal to the taxable income, which give rise to these differences. Some of the differences are permanent and some of the differences are temporary. Permanent differences are those items like which either included in your book income or in your taxable income, not in both. For example, if we talk about municipal bond interest, it is a taxable income for book. It is a income for book purposes, but it is a tax exempt income in case of taxes. Similarly, life insurance proceed, it is a non-taxable income. Fines and penalties you can deduct in from your book income but not from your taxable income, so it is a non-deductible expense for the tax purposes. Similarly, political contributions, key insurance, key person insurance premiums and DRD. So these are some of the differences which give rise to permanent differences, which means they either included in your book income or in tax income, not in both. Okay. Next, we talk about temporary differences. So temporary differences are those differences which are actually due to the timing difference. Like certain of the items are recognized in book income today, whereas maybe in future in case of tax purposes. Or due to some difference in the method like for depreciation. Bad debt expenses, for example, in book income, we create an allowance for bad debt, whereas for tax purposes, we do not have to create any allowance. We actually write we actually shows the expenses only for the actual write-off. Warranty expenses, unearned revenue, prepaid expenses. So these are some of the differences which give rise to the temporary differences. Means this differences is due to the timing of the recognition of the income or expenses. Okay. So these temporary differences usually give rise to our deferred tax liability and deferred tax asset, which you already studied in FAR, if you have studied FAR. Okay. Any doubt till here?
No, ma'am.
Okay. So how is the reconciliation happen? You have to first report your book income, then reconcile this book income to the taxable income. So first you have to add your non-deductible expenses, then add the book expenses not deductible yet, means the expenses which you have not deductible yet. Next is you will subtract the non-taxable income which you already shown in your book income. For example, your municipal bond interest, your life insurance proceeds. You will subtract the tax deductions not in books, and you will group the taxable income. So you have to reconcile this in and show it in your schedule annual. Okay. So for example, suppose your book income is $500,000 and certain of the items are given which you have to done certain adjustment to get your taxable income. Okay, so first of all is municipal bond interest. So what do you think, municipal bond interest is taxable or non-taxable? Anyone? Municipal bond interest is a taxable item or non-taxable?
Non-taxable.
Yes. So you have to add back or subtract from your book income to get your taxable income. You have to add this amount or subtract. Yes. So you have to subtract these items from your book income. Next, federal income tax. So federal income tax, is it deductible or non-deductible expense for taxable purposes?
Non-deductible.
Yes, that means you have to add it back. Okay. Next is your excess makers depreciation is $20,000. So excess makers depreciation means the depreciation you are recognizing in for tax purposes is 20,000 more than your book purposes. That means you have to add this back. Sorry, you have to deduct this additional depreciation expense from your book income. Okay. So bad debt is given. For book purposes, you have subtracted the $15,000, but for tax purposes, it is $8,000. That means you have to add back this 15,000 and subtract the 8,000 of expense. That means net addition is for $7,000 and it will give you a taxable income of 522,000. Okay. Any doubt in this topic? So sometimes you are given some questions related to this topic. You are given some book income and certain items which you have to do certain adjustment to get your taxable income. So you have to keep in mind what items are included in your book income or not included in your taxable income. Okay.
Yes, ma'am.
So some of the examples are given here. Okay, talking about meals, what do you think? Meals, since meal expense is only 50% deductible for tax purposes, that means other 50% will be a permanent difference or a temporary difference. Can you deduct additional 50 in the next years?
No, ma'am.
Okay, so that means it is a permanent differences. Okay, so these are some of the permanent differences are given, like DRD. We will talk about DRD in later slides. So DRD is a special kind of deduction given to a C corporation. Okay, it is also a permanent differences because it is only given for the tax purposes, not for book purposes. Clear? Similarly, for temporary differences, which are actually due to timing differences, like depreciation method, your bad debt expenses, your warranty liabilities, unearned revenue, prepaid expenses. Because for tax purposes, you recognize your income when it is received and your expenses when you have actually paid them. Okay. Okay. So, what is the difference between Schedule M1 and Schedule M3? So both of the M1 and M3 shows the reconciliation of your book to taxable income. But small companies generally use the schedule M1 while large one have to file the schedule M3 because M3 is a detailed explanation of M1. Okay. So if a company or a corporation has a total asset of 10 million or more, they have to file the Schedule M3 instead of Schedule M1. So the basic difference is Schedule M3 is more detailed explanation of Schedule M1. Okay, is it clear?
Yes,
Any
ma'am.
Yes,
okay.
ma'am.
Okay. So next is the overview of C corporation taxation. So talking about C corporation, they have to file the form 1120. To file their tax return, they have to pay taxes on whatever the profit they are earning at the entity level. And the flat tax rate is for the C corporation is 21%. They also have to subject to double taxation. That means if they distribute their dividend to the shareholders, then the shareholders also have to pay the taxes on this dividend. That means they are subject to double taxation. Talking about corporate tax formula. So first of all, you have to report the gross income, whatever the income a corporation is earning. Then from this income, you have certain deductions, which are ordinary or charitable deductions. After deducting these deduction, you will get the taxable income before special deduction. Next, you have certain special deduction, which is DRD, dividend received deduction, and annual net operating loss deduction. Then you will get your taxable income on which you will calculate the taxes, and certain credits are available for C corporation also, which can be used to reduce the tax liability, and you will get your final taxes due. Okay. So common corporate deduction, if we talk about, first of all, if we talk about the gross income. So gross income means what income is a company is receiving. Okay, so it may be uh, from its uh, operations, also from other like non-operating items are also included in gross income, like if they are receiving certain kind of dividends, certain capital gains, so this will be included in the gross income. Next, you have certain corporate deductions. Corporate deductions means they can have ordinary deduction as well as charitable deduction. Ordinary deductions means like the salaries, wages, any bad debt expenses, any rent the company is paying, any taxes, any interest, any compensation of officers. So they have certain ordinary deductions like depreciation also. Organizational and startup cost, like for the tax purposes, if you have certain organizational and startup cost, then you can deduct the $5,000 immediately, and rest of the expense you can amortize over the 15 years. Okay. You also have charitable contribution that you can get the deduction, but the limit for deduction is up to 10% of your ATI. Okay, adjusted taxable income. Next, you have business interest expense. So, for example, if you have taken certain kind of loan to run your business and you have business interest expense on this loan, then it will be subjected to certain limitation. But this limitation is only for the large organization, like which have their gross receipt more than 30 million. Okay, you can also have officer compensation, like if you are paying the compensation to officers, then you can deduct these expenses. But if these officers are the are on the top position like CEO, CFO, and other three most like compensating officer, then for this you have limitation of 1 million for for each officer. Okay, so for each officer you can't deduct more than 1 million of expenses. Next, you have capital losses. So for the C corporation, you can only deduct your capital losses up to the amount of capital gains. Okay, here no 3,000 limit is given as in case of individual. So you do not get any additional deduction on capital losses. For C corporation, instead you can carry back it for 3 years as well as carry forward for 5 years. Okay, any doubt till here?
No, ma'am.
Okay, so next is our dividend received deduction. It is an important topic, and you have the asked certain kind of questions on this topic also. So dividend received deduction is basically given to the C corporation to avoid triple taxation. How's triple taxation? For example, like a company is earning certain dividend from the another company. Okay, like a C corporation is receiving a dividend from other C corporation, and that dividend they are first the corporation is paying taxes at the entity level, and when they are given to other corporation, they also pay the taxes on these income. And if they distribute the dividend to the shareholders, then the shareholder also have to pay the taxes. It means there will be a triple taxation. So in order to avoid the triple taxation, they have dividend received deduction. So dividend receive deduction, to get this deduction, you have certain eligibility criteria. Just okay. So dividend receive deduction. Just so DRD is basically given to the C corporation, and to qualify this, the stock should be a qualified stock. Okay, it is not applicable to any preferred stock, and the deduction limit is depend upon the ownership. Okay, so if you have less than 20% of ownership in another C corporation, If you have less than 20% of ownership, then you can get the 50% of DRD on dividend you are receiving. Okay, it means 50% of the dividend you are receiving, you can get the deduction. But in case if you are having the ownership above 20%, okay, above 20% or more, like up to 80%, then you can get the 65% of the deduction. And if you have more than 80% of ownership, then that means you will become a consolidated company. Then in that case, you intercompany dividend will got eliminated and you will get the 100% of DRD deduction. Okay. So how is this DRD is calculated? So basically, the percentage of DRD is calculated on the lower of the two amount. Which two amount? Your dividend income or your taxable income. Okay. So your dividend income or your taxable income, dividend income or your taxable income. So whichever is the lower amount, you have to calculate the this dividend percentage on that amount. But in case if the dividend your DRD you are getting on your dividend income is leading to negative taxable income, that means you have to calculate this dividend received deduction only on the amount of dividend income, not your taxable income. Okay, so let me check if there is any example in your book. Okay, let's take this example first, then I will take another example. So you have a corporation which is having the sales of $900,000 and the cost of the goods sold is $300,000. Your officer salaries are given, rent is given, depreciation, charitable contribution, dividend income is given. So you have to calculate the taxable income first. Okay, so the basic formula to calculate the tax is, first of all, you have to report your gross income and subtract the ordinary deduction. So what should be the amount of income and deduction? Anyone? Which is income from these items?
Sales and dividend.
Salaries and,
Sales. Sales and dividend.
yes, sales and dividend. So that means your income will be 900 plus 40,000, 940,000, your gross income. Then you will have certain ordinary deductions like your COGS, your officer salaries, your rent, depreciation. So how much ordinary deductions are there?
5,80,000.
Yes. Okay, so you will subtract these ordinary expenses. Then you have charitable deduction. So limit for charitable deduction is up to 10% of your ATI, adjusted taxable income. So your charitable limit is 36,000. That means your 20,000 expense is fully deductible. Okay. So dividend income is 40,000 and your ownership is less than 20%. So how much DRD will be applicable? So how much DRD will be applicable here? Okay, let me calculate it. So if you first calculate your gross income, it will be your income, like your sales, your dividend income. So it will give you $940,000. Okay. Then you have your ordinary deductions. So if you calculate your ordinary deductions, it will be your salary, your COGS, your salaries, rent, depreciation. So it will give you the deduction equals to 580. Okay, if you subtract the gross, this ordinary deduction from your gross income, you will get your ATI of adjusted taxable income of $360,000. Any doubt till here? Then you have your charitable deduction, which is up to 10% of ATI. That means if you calculate this limit on your ATI, it will give you $36,000. That means up to $36,000 you can deduct your charitable expenses. So that means you can fully deduct these expenses. So deducting your 20,000 of charitable expenses, it will give you net taxable income of 340,000. Then you have certain special deduction, which is dividend received deduction. So it is depend upon the ownership. Since it is less than 20%, that means you can get the 50% of deduction on this dividend income. So if you calculate your dividend received deduction, it is lower of your dividend income or your taxable income. So what do you think? $340,000 is the lower amount or $40,000 is the lower amount? This taxable income or your dividend income, which is the lower amount?
Dividend income.
Yes. So you will calculate your DRD on this income. Since it is less than 20%, that means you can get the 50% of deduction. So subtracting 50% of 40,000, which give you $20,000 of DRD. So it will give your 320,000 of your net taxable income. Any doubt? Any doubt?
No, ma'am. No, ma'am.
Okay. So let us take one more example on this DRD. So assume that your dividend income is $100. And your sales, let's take, is 550. And your ordinary deductions Deductions of force evicting. Okay. So can you give the taxable income in this case? So I am not taking any charitable deduction here. So simple example is given. Please calculate the taxable income for this values.
$130.
How much?
615. 180.
180 is the total taxable income, or it is income before your DRD.
Before DRD.
Yes. So how much DRD will be applicable?
50% of 100.
Okay, let ownership I have not given. So let's take the ownership of 20% here. Okay. So if you calculate first your gross income, it will be 550 plus your 100. So your gross income in this case will be 650. Okay. From your gross income, you deduct your ordinary expenses. Ordinary expenses. So your ordinary expenses are $470 here. And you have also charitable deductions, since I have not given any charitable deductions here. So skip this part. Then you get your income before your special deduction. Okay, so it will give your income 650 minus 470, 180. Okay, then you have special deductions, which is DRD. So DRD is given based on the percentage. Since it is a ownership of 20% or suppose less, then you have how much of DRD? How much of DRD? If you have less than 20% of ownership, then how much of DRD is applicable?
50%?
Yes, 50%. So this 50% is calculated on lower of this income, okay, your taxable income before DRD, or your dividend income. So what do you think, 180 or 100? Which is the lower amount?
100.
Yes, that means you calculate the DRD on this amount, you get the $50 of DRD, and your taxable income will become 130 here. Okay, so deducting this DRD, it will give you $130 of your taxable income. Any doubt till here?
No.
And
No,
other
ma'am.
Shravani? Okay. So if you do not have any doubt here, I am modifying this example. Please do that now. Okay. So let's take the same example, but changing the ownership here to 40%. So please calculate the DRD now and taxable income.
It's full 100.
Okay. It's
100. And taxable will be 80.
Okay, DRD is of $100, but
580
lower of
is
this
what?
amount. So you will, if you have ownership more than 20%, then how much DRD? 65% of DRD will be applicable. So if you
Then,
have ownership
okay, more than
greater
80 is
than
100%.
20%, then it will give you 65.
Then 65 will be minus 180 minus 65.
Yes, and it will give you the taxable income of.
115.
Okay. Okay, let's change this example. Suppose you have sales of $400 here. So now calculate your DRD. So you have sales of 400 and dividend income of $100. So please calculate the DRD and taxable income.
Gross total income will be 500. Tax before DRD will be 30. DRD will be 19.5.
Okay. So, okay. Gross income will be your 500 adding the sales and dividend income. Then you have your ordinary deduction and it will give you $30 income before special deduction. So how much DRD you have calculated?
30. On 30, I have calculated 65%.
And others, is it right or wrong? Yes. So as I told you, the DRD is always calculated on lower of your taxable income or DRD income, or sorry, dividend income. But in case if you are applying the full DRD, means if you are applying the DRD limit on dividend income and it will give you the negative cash flow, then DRD is always calculated on the dividend income only. Okay, then lower of the amount will not be applicable here. So if you're applying DRD percentage will give you net operating losses, then you do not have to consider the lower amount. You always calculate this DRD on the dividend income. Okay. So if you apply the dividend received deduction on dividend income, it will give you the deduction of 65. Okay. So if you deduct the 65, it will result in annual or not. It will give you net operating losses or not.
So here, the income before DRD is 30. It's a
Yes.
positive, no, not negative. 500 minus 470 will be 30 positive.
Yes, but if you calculate the dividend received deduction on dividend income, then it will give you the negative net operating losses.
Then why this 65% is not on 30 and why it is on 100?
It is the rules that
No,
if
but if your income before DRD is negative, then only you have to compute the percentage on dividend income. Now, here it is coming positive.
no, in this case also, like if you apply the dividend in DRD on your
Hmm.
dividend income and it will result in the annual, then you have to calculate this DRD on dividend income only. Okay, lower of the value will not apply here. Also, if you have net operating losses here also, then also this DRD will be calculated on the dividend income.
So you are comparing this 30 with 65.
Yes.
Okay.
So if you apply the DRD on your dividend income and it will result in net operating losses, then this DRD is always calculated on dividend income. That's why I have taken this example. So it will give you the taxable income of minus 35. Any doubt till here? Anyone? क्योंकि क्वेश्चंस आते हैं इस टॉपिक से.
No, it's clear at my end.
And Shravani, Aksa.
Yes, ma'am. Clear.
Okay. So let's take one more example. Now your dividend income is 100 and let's take your sales here 350. So now calculate these all values. So what will be gross income now?
450
450. And your income before special deduction
minus 20.
minus 20. So now DRD will be applicable on which amount? Lower amount will be considered or only dividend income will be considered?
Only dividend income will be considered.
Yes. So now you calculate your DRD only on the dividend income. So it will give you 65. That means you have net losses of $80. Sorry, $85. Okay. Any doubt? Any doubt? Or is it clear?
Clear.
Okay, next topic is annual. So net operating losses. So if a C corporation is having the net operating losses, then how much these losses can be carry forward or carry back and how much it is deducted. So key rules say that if you are having the net operating losses beginning after 2017, then it will be carry forward indefinitely and carry back will not be allowed. Okay. So earlier, what happened if you are having the like before 2017, if you are having net operating losses, then it will be carry forward for 2 years and carry back for 2 years and carry forward for 20 years. Okay. But now the rules say that you can carry forward indefinitely but can't carry back. Also, annual deduction in any year is limited to the 80% of taxable income. Up to 2020, it was 100%, like 100% of this of losses you can deduct, but now this limit is 80%. Okay. For example, suppose in 2024 you are having the net operating losses of $400,000 and in 2025 you are having the taxable income of $300,000. So since this is after 2017, that means you can carry forward indefinitely and the deduct up to the amount of 80%. So if you calculate your 80% of this income, that means $140,000 of losses you can deduct as an annual deduction. So that means it will give you the taxable income of $60,000 and remaining annual you can carry forward to the next years. Is this example is clear?
Yes,
Yes.
ma'am.
Okay, if we talk about pre-2018 NO example. So suppose in 2017 you are having the loss of $200,000 and in 2025 you are having the $300,000 of gain. So since the loss is happening before 2018, that means you can carry back as well as carry forward, and there is no limitation to deduct these losses. Since you do not have any carry back income given here, it means you can carry forward to the next year and there will be no 80% limit. You can deduct this amount from your taxable income. Okay. Any doubt in this example?
No, very much.
Okay. So next is mixed annual. So if we talk about pre 2018, post 2017 rules, if applied, then you have to apply pre 2018 annual first, like there will be no 80% limit. Then you have to apply the post 2017 annuals, which will be subjected to 80% limit. For example, if you are given some losses pre post 2017 or pre 2018, pre 2018 and post 2017 losses are given, then you have to apply the 2018 rule first. It means no 80% limit will be applicable on those losses. And then for post 2017 losses, you have to apply the 80% limit. Like you have these two losses are given. So if you apply the 2018 loss first, then there will be no limitation of 80%, and after that you will apply the 2017 losses and it will subject to the 80% of limit. Okay, so this is the order given if you are having the both losses pre 2018 and 2017. Okay, so annual do not affect the charitable contribution deduction limit. So when you calculate your charitable contribution deduction limit, which is 10%, this annual will not be considered. DRD calculation, you do not consider the annual, and for AMT, alternative minimum taxes, you do not consider the annual. Any doubt in this topic?
No, nothing at my end.
Sorry.
No doubts.
Okay. So next topic is capital losses. So if we talk about the capital losses deduction for C corporation, you can deduct these losses up to the amount of your capital gains. No excess losses will be deducted from other income. Net capital losses you can carry back for 3 years as well as carry forward for 5 years, and all the losses will be considered as your short term losses. Okay. One more thing, there is no special tax rate for capital losses, capital gains for the C corporation. It will be taxed at the ordinary rate only. If we talk about the order, apply to the earliest carryback year first. For example, if you are having some capital losses in 2018 and some capital gain in 2017 and 16, so you will first apply to 2017, then go for 2016. If we compare it with individual, in individual you have additional $3,000 of deduction that you can deduct from other sources. But for C corporation, you can't deduct any excess of losses from other income. Okay. Any doubt?
No, ma'am.
Okay, then we will discuss the S corporation in the next class. And then we have partnership taxation.
Okay.
Okay, ma'am.
Okay, please revise up to here.
Yes, ma'am.
Okay, bye.
Thank you, ma'am. Bye.
Bye bye. Thank you.
Welcome. Bye.